You have probably heard the old adage, retirement is not about necessarily the pile of money, but about the cash flow. And oftentimes when you think about real estate, for the smart investor, that is equally true. It isn't always necessarily about how much resale value you're going to have in a property, but what kind of cash flow is it producing? That's important whether you're looking at cash flow heading into retirement or heading toward retirement. We spent some time today talking about real estate investing from a different perspective. Now, we've all heard about the buying and flipping business that was wildly popular prior to the 2008 crash. Has that settled down? And are there vehicles out there that allow someone to invest in real estate without having to deal with the burden of becoming a landlord? You can't see my air quotes here, but you don't want to deal with the issues that the typical landlord has to face. So what are the options out there? Well, joining me today in studio is a real estate investing expert. In fact, he's been at this for more than 30 years now. His name is Tom Wilson with Tom Wilson Investment Properties. And of course, to the KDOW audience, you are no doubt familiar with Tom and his work on his weekly program right here on KDOW. Wilson Investment Properties, providing high-quality turnkey cash flow rental homes and commercial syndications. And Tom, great to have you on the program.
Thank you so much, Greg. Nice to be on the program. It's fun being on the other side here.
It is indeed. Now, let's talk about this issue of real estate investing. I mean, I think to even the casual investor out there, we recognize that there are limitations in what you're going to be able to do in the securities arena. These days, in particular, the guaranteed 12, 14, 15% ROI simply isn't there anymore. And so more and more people look at real estate, but those that look at real estate without any previous experience might get very intimidated, not only by the numbers, but the concern that, gee, I'd like to be able to take advantage of the appreciation of real estate, but I just don't want to deal with all the headaches of being a landlord.
I think that's there are two main mistakes that people make today. Originally, I've been investing now for over 40 years, actually. Over 5 decades, and the message has changed. In the early days, people would recommend, gurus included, go look in your own neighborhood, and that's where you buy your product, because you can understand the neighborhood, you know what's going on. And they would do that, and two things would happen. One, where they chose that product neighborhood may or may not have been a good place to invest. Number two, because it's close by, they kind of felt responsible or compelled to do the repairs, to landlord it. Well, I'd certainly say as time went on, I realized that that's a mistake, that you should not confuse investing with landlording. They're two separate things. I always believe in delegating to experts, leverage your ability. Don't take up your time doing things that you can delegate to an expert. Focus on investing. You'll get to your end goal faster. Let someone else do that. So I would say, number one, delegate out the landlording part so you can focus on investing. And then two, and we'll get to that probably more later as time has gone on, places other than where you live have become, much better returns. And it's kind of like when I struggled with that first concept, someone who was very experienced and successful said to me, Tom, why are you so concerned about going out of state to invest somewhere else? Says, when you buy stock, do you buy stock only in companies that you can drive to and kick the building? Or do you buy it because it's the best return on investment and there's no difference in in real estate?
Well, affordability and return on investment really at the end of the day is key. And as you suggest, if we look at some of the median prices of homes in the San Francisco Bay Area, and particularly for a San Francisco Bay Area based audience, more and more, particularly for the novice investor, buying on the street where you live, flipping it, or becoming a landlord is getting further and further out of reach. And I guess to a great degree, the numbers just don't make any sense anymore, do they?
No. Well, take a look at the example. My first house that I bought in 1970. It's a while ago. And yes, we've had quite a roller coaster since then. I'm watching cycle number 5, as I tell people who are shocked that we had a crash recently. Well, yeah, it was a little bigger than average, but it's not uncommon to have cycles, and that's okay, as long as you work with it. But the first house that I bought, $30,000, 30.2, I remember very well. My wife's hand was shaking as we were as we were signing the contract on it. Little did she know what lay ahead. That house rented for $300. So as those in real estate investing know, the magic rule of thumb in real estate investing as far as houses go is that rent has to be about 1% per month of the value of the home with a 20 or 25% down payment in order for that house to cash flow. Well, it barely worked then. It was okay. That house today is worth $900,000 and rents for $3,000. Now the headlines focus on $3,000. Oh my gosh, what outrageous rents. Well, it turns out that that's the lowest rent per invested dollar for any place in the country other than New York City. So let's see. So now we're getting 0.33% per month of rent for the value of the home versus 1. Basically, you're getting a third as much income. So what could you do differently? Well, you could take that $900,000 house, you could sell it in a tax-free exchange, tax-deferred exchange, to say more correctly, into another metro where you could buy 8 or 9 houses that would bring in, for that same amount of invested money, $9,000 back to the 1%. There are actually places in the country where you can do that. So the reason is, as houses appreciate in value, rents never appreciate as much. So as houses go up in value, their returns get less and less. So you need to go find some place where you get that 1% ratio. So which would you rather have with $900,000 worth of real estate to buy? $9,000 a month income, $3,000 a month income. Don't need a CPA to figure that out.
No, it's very basic in that regard. But then, of course, people say, well, my goodness, we're talking about dealing with real estate out of the market. I'm concerned about management issues. If I know how difficult it is to be a landlord here locally where I can run down the street and go see what's going on with the plumbing at 3 o'clock in the morning, I don't want to have to get on an airplane. And isn't it expensive if I bring in an outside or third-party manager to look over such things?
So like any profession, there are those that are good and competent, and there are those that are not. So indeed, getting the right management, the same as investing in a corporation, that you want that company to have good management. You invest in real estate products, you want that product to be well managed. So you can go through the research yourself and maybe have some mistakes before you find the right one. A better choice is to find a team or a turnkey provider who's done that heavy lifting for you, has the experience, has their own skin in the game to pick it for you. And yes, 10% sounds like a lot to pay for a property manager, but when you look at all of the parameters that affect the bottom line, that's cash-on-cash return or internal rate of return, and you look at all the different ones, taxes, insurance, interest rates, and rent ratio and property management fee, you will find, and I've run these stats because I couldn't find it published anywhere. Being an engineer, I actually run some of these statistical studies called sensitivity analysis, and you'll find that by far the rent ratio has more impact on the bottom line than anything else. Number 2 is interest rates, and number 3 is taxes, and property management fee is almost negligible in the end. So that's not the percent. People spend a lot of energy beating up the property manager to save 1%, but they'll go to some city where the rent ratio is 0.5. It's nonsense. They're barking up the wrong tree.
Let's talk about some of your motivations to first get involved in real estate investing, Tom. I mean, certainly, as we've indicated, given the current status of what's happening with the securities industry, trying to make money on Wall Street the way we used to is not quite as easy. And so while the opportunities might be brighter in real estate investing, a lot of people perceive that there's also a commensurate amount of risk involved, not just the details or the hassle of property management as we've been talking about, but also issues such as, well, what happens if there's a major downturn in the market? I lose half the value of the house. We've seen it happen as recent as 2008. So in terms of some of the motivators for you, why did you decide to get involved, given all of these risks, in the arena of real estate investing?
Well, before I thought that much about it, I had not initially said, well, my goal is when I get in my career to go into real estate investing. Hadn't even crossed my mind until I came out with Fairchild from Virginia out to what was to become Silicon Valley in 1969. To my surprise, the landlord lived next door, and he owned most of the street. He didn't have a college education, but he was very street smart. He was one of those people, Joe Martin, bless his heart, whom if I was on a deserted island, he was the one I wanted with me. And one thing he'd figured out was the value of owning real estate. And, at that point, those were houses that cash flowed. I tell people never invest in something that you hope will sort of cash flow maybe someday, and you're really speculating on appreciation. If you do that, just know you're speculating and gambling. You're not really investing. So I think what I like about real estate investing, as I learned and started to invest myself, is that it's a leveraged way to own an asset that is tax sheltered, has cash flow, and has appreciation. Real estate does have its cycles, but if you look over time and you look at all kinds of real estate, whether it be single-family residences, commercial, multifamily, they've all outperformed on the average the S&P 500 or the Wilshire 5000, which is to many people's surprise. Now, that's over the long haul. Of course, you can pick any short segment to prove your case in either direction, but I like to tell people that in all the things I've invested in, and yes, I've invested in stock and oil and gas and dairy and consumer-based franchises and lots of different kinds of things. And my conclusion is that real estate is the best get-rich-slow scheme there is.
Tom Wilson today with us in studio. We're talking about the world of real estate investing. We'll take a brief time out, come back to more of the conversation right after this. Welcome back to the program. With me today in studio is Tom Wilson from Wilson Investment Properties. And as we mentioned at the get-go, Tom is involved in the arena of real estate investing for 40-something plus years now, Tom. And you got into this sort of casually with one initial buy many years ago. And now here you are involved in this arena full-time. And the one question, I guess, for the novice real estate investor out there is, well, this whole business of flipping, we heard so much about flipping, particularly prior to the 2008 crash. Is that what investing is all about?
Well, that's not investing. Investing in its strictest sense to me, that's a business, and it's an okay business. Investing is something where you put your money into something that you believe will have long-term cash flow and appreciation benefit. Flipping is a business. It is. I've done a lot of it. Hundreds, in fact, of properties, but I use my engineering and experience and my analytical approach and systems approach to set up systems so that I didn't make a lot of money on each one, but I've rarely lost money and put in very strict standards and have a great team around me. I've always believed in having people working for me that are much more much smarter and much more successful and experienced in areas that I'm not. Some people are afraid to get somebody who might be smarter than they are because they don't want to be shown up. But I think that's the way you win. So I've had success in flipping, but with very, very carefully controlled systems and very careful selection criteria, very strict standards. It is, and I'll tell you, in this day and age, it is very difficult to find products with enough margin in it to be successful. I definitely do not recommend to someone to start in flipping in this age. Many people now who are flipping are assuming that they will be able to make money because the value will be greater when they're finished the rehab and sell it than it is now, and that is a very dangerous place to be.
There is also a huge requirement of capital outlay at the get-go.
Yep.
And I suppose that there's been a very false picture painted by the reality TV shows. Anybody who's handy with a hammer and a screwdriver may watch those programs and say, gee, is that all there is? Well, my goodness, I can come in and throw up some sheetrock and a coat of paint and flip a house and see myself, double my initial investment or whatever the case might be. And, of course, as we find out, it's a lot more involved in that. The risk at the front end is higher because of the capital outlay. And as you point out, the guarantee of that appreciation within a short period of time to make it make sense is just simply not there anymore.
Most of the flips that I've done have been to been to supply high quality, highly transparent rental houses in other places like Dallas to investors. And those are cosmetic upgrades. They are simpler to do, less risk. However, the competition is fierce. So it's very, very difficult to find product even years ago, but especially now, that meets enough of the criteria. So how do you avoid, if you want to flip something to make money, how do you avoid that? Well, you get into a space where most people can't compete, and that's ones that take more money up front. They take more cash to do the rehab. There's more uncertainty about what the resale value will be, and so forth. But what they don't realize, the last several high-end flips I did, for example, one of the latter ones I did, I paid $1.2 million for a 3,000 square foot house in Willow Glen, put $500,000 into rehabbing it, and I sold it for $1.95 million. That all sounds great, but I estimated, just for fun, people started asking me, and I looked back over the last few that I'd done. I estimated that there were over 2,000 decisions made in that flip. You think, how could that be? It is. Some of them you make very quickly, but the old 80-20 rule certainly applies, maybe the 90-10. Those few are very critical, and when you're up in that space, the floor plan, the volume, the finish, all of those details can make a difference in that kind of house and $500,000 in what it sells. So they have to be made very accurately, and it takes a lot of time, and you're still at risk. You can I've hired 3 interior designers for one product and consulted with 2 or 3 different realtors who specialize in that area, and you get 5 different answers. And in the end, you've got to make the decision. That's your risk.
It almost sounds like you've suddenly switched from being an investor to just having a job.
That is very much a job. It's a business. You're extremely active in it, even if you delegate it out. It is if someone's going to do that, what I recommend they do is go find someone who's doing it, who's successful, and ride on their coattails. Be willing to put in sweat equity to learn from them. Don't strike out on your own. This is don't just take one of these boot camps that tell how easy it is to do, and that's the only way to do it. But it's really, I think, in most markets in the country, it's been popular flip. I've got to believe we're in a market cycle where we're getting close to peaking out again. So that's a risky place to be.
And to close the door on this topic, a final question. You use the word quality property. I would imagine then you're suggesting that the idea of going to an auction site and buying, 5 houses for $7,000 in Detroit, probably not a good idea.
Well, the market is thousands of submarkets, and it depends on the specifics. It might be okay, but my philosophy, and the one that's worked the best, and occasionally I've strayed from it briefly and keep coming back, and that is I always prefer buying a product, if I'm flipping it, that is in a high demand area and it's going to be relatively easy to sell, even if I don't get as good a deal. If you're in an area where you can get a unbelievable bargain, there's got to be a reason for that, and it probably is that by the time you sell it, it's probably going to take a lot longer, and you're going to have to discount it from what you originally thought you'd be able to sell it for. And it's much better to get products in areas that have a high demand.
So a place where people are going to as opposed to leaving from.
Indeed.
Makes perfect sense. Now,
Yep.
let's spin this topic into the issue of the local investor who says, okay, I've analyzed the local market. I understand that sort of the approach of on the street where you live is probably a bit beyond my reach. I understand what you're saying in terms of going out of market, but then the question comes down, what are the options here? Do we look at single-family homes? Do we look at becoming a landlord or purchasing a multi-dwelling property? What are some of the pros and cons of those approaches?
Well, for single-family homes, I like it. I still hold a number of them in my portfolio. Why? They're more liquid. You have total control on it. They tend to appreciate more because they're driven by the owner-occupant market, not by the income. You can refinance it, get a loan on it. Can distribute the risk in various areas. Having said that, the returns are not as high as a well-selected and managed multifam or commercial property. And 2, in the market that we're in right now, with such high demand relative to the supply, and that's most major good markets across the country, it is very hard to find good products. So what we've done is, rather than lower our standards, we just come across less products by volume than we used to. So the ones that we're still offering to our investors work well, but it's we can't meet the demand of our investors for the number they want. Now, we have a lot of folks that say, I'd like to buy a multifam or a commercial product. I have a lot of money. I have a good FICO score. What they don't realize is that if you're not already in the business in this relatively tight money market in the multifam commercial world, there's enough of those. It's a totally different world when you go from in the 1 to 4 units. That's a residential loan, and that's mostly controlled and bought by Fannie, Freddie, the government, and those subsidized. Once you go beyond 4, 5 units and up is what we truly call multifam. A four unit is not really a multifam in the investment world. So the lenders got pretty burned during the crash because they had a lot of folks that come from New York, California, so forth, new to the business, bought a lot of multifam commercial products, and a high percentage of those are ones that didn't know enough about it, even though they'd hired a manager, maybe were undercapitalized, and they lost the product.
Some of this a bit contrary from the standpoint of the intuition would say to you, well, if I'm going to buy a duplex and I lose one tenant, I'm 50% vacant, as opposed to buying a fourplex, and if I lose one tenant, I'm only 25% vacant. I mean, that would seem to be the logic that drives this.
Well, indeed, the more, on the average, everything else being equal, the more units you have per building, the higher potential return you have. But to do it on your own, if you don't have experience with it, is difficult. And the lenders now, because they had a higher percentage of defaults and foreclosures with newbies, basically I almost say, without exception, you cannot get a loan if you don't already.
So they're both tightening the terms, and I would imagine probably increasing the rates too?
No, just tightening the terms.
Okay.
So if you aren't already in the business, you really can't get a multifam loan. You could get a commercial one if you have a relationship with a bank and you're buying it in your local region. You can do that. Fannie Mae will not entertain any application by someone who doesn't already own multifam house. So I like multifam, but right now there's way too much demand relative to the supply. If you're trying to do it on your own, you aren't in the business, you can't get it. And commercial products now in the last couple of years or so now certainly aren't under the radar, but they are not as high up on the curve of peaking out as multifam is in general in the major markets. So that's why I've been investing almost exclusively in commercial products, and that includes retail, industrial, office spaces, because we're getting returns of about 2% higher than you do on multifam in these markets.
So as you're suggesting, there are a number of new barriers that can be prohibitive, particularly for the first-time investor. So then what are the options? We'll talk about that next. Tom Wilson today with us in studio. By the way, if you'd like to get more information about Wilson Investment Properties, it's easy. You can simply log on to TomWilsonProperties.com. That's TomWilsonProperties.com. We'll also be telling you about a very special seminar coming up later this week, so stay tuned for that. We'll come back to more of our discussion as we look at real estate investing today with Tom Wilson. Back with more right after this. Welcome back to the program. On this edition, we are pleased to have in studio with us today real estate investment mogul. Can we use that term, mogul?
Oh, my gosh.
Are you ready for that term yet, Tom? People that are just tuning in, Tom Wilson is with us today. And, of course, Tom has been involved in the arena of real estate investing for, my goodness, 40-plus-something years. You've done how many flips? Over 400 flips?
We've bought and sold about 3,000 units.
Oh, my goodness. Wow.
A couple $100 million worth in the last
So the title mogul may indeed.
We're getting
repeat fit.
Well, sometimes the word slips out from someone, tycoon, and my wife quickly corrects him and says maybe typhoon.
Wives can always bring about that reality check, deflate the ego real quickly.
They're real good at bringing us back to earth. But
and we're kind of doing the same thing today for listeners that are interested in real estate investing. And of course, we hear all of the excitement, and I think it's the saying often goes, there are two types of people when it comes to real estate investing: those who are in it who want out, and those who are out of it who want in. So with that said,
I don't know if I know too many people who are in it who want to get out. I don't know anybody right now who's selling their real estate to get into the stock market. I'll tell you that.
That's probably very true. And as alternatives to the stock market go, I think more and more investors are realizing that there are some opportunities, if you play your cards right, in real estate investing for the mature investor. And let's talk about that for a moment.
Before we get to that, if I may interrupt, there are some reasons for getting out of real estate. That is if you're holding a bad one for whatever reason,
sure, or
one that isn't returning nearly as much as you can somewhere else. So one of them, there are multiple ways that real estate provides tax benefits. You get sheltering because you can take depreciation against your income. So an 8% return is really more like a 12% on something that you can't have tax sheltered. And also there's the tax deferred 1031. So if you have a property and you want it's not performing well or as well as something else, like you have a $900,000 house bringing in $3,000, and you want to go to another place like Dallas where you can have $9,000 worth of income, you can do a 1031 tax deferred exchange, and you pay no capital gains. And you can keep on doing that until you die, and then your cost basis goes up, and your kids take over something with your real estate that you've built up and pay no capital gains.
So there are some huge advantages from a tax strategy standpoint.
Yeah, I think we're always told from the early days in 101 you never invest in something just because it has tax benefits. It's got to be a good investment first, and then if it has tax benefits on top of it, that's a bonus, and that's great. So.
Let's talk about the good investment angle to all of this. We were talking prior to the break about some of the differences between single-family residences versus multiple occupancy, and some of the limitations that are there in terms of preventing first-time investors from stepping up into anything that really is serious multifamily, five units or more. One of the areas that is becoming more and more attractive to investors is this arena of syndication. Help us understand exactly what it is and what some of the advantages are in terms of, I guess at the end of the day, being able to really leverage the power of many into buying really first-class, high-quality, high ROI properties.
Most of us have assumed that that's something that the other guys did. The institutions, the REITs, the very wealthy investors, they bought multifam and commercial products, and they had this exclusive club right to have these better products, and that was just something that was out of reach to the typical investor. Yes, a lot of investors reach the point where they can buy maybe a tweener, as we call it in the business, where it's more than 4 units, but maybe less than 20 or 30. And the problem with those is that the income generally is not enough to afford to pay for full-time on-site staff, and that's where you start to make the difference in performance. If you can have control of the property and your tenants, and you can have the economy of scale of maintenance. But usually that's generally a product that is bringing in $40,000 a month in rents. So that's getting to be, in most markets, a $2.5–3 million property, and you've got to put down 25% of that plus reserves, et cetera, et cetera. So it's still getting pretty expensive. And again, if you don't have a track record of doing that already, you really can't get loans. So what do? You partner up with somebody else who can. So that's one approach you can take. Another approach, which is a lot easier and has less liability, is a syndication. Now, the word syndication puts some people on their heels because they only have heard it in movies when it was referring to maybe a cartel or something syndicating something. But syndication has been around for thousands of years. It just means a collective people with like mind, goal, and interest putting their money together to go finance something that they feel will give them gain over time. That's all it is. Now, of course, like everything else, it's become quite regulated and complicated, and the Securities and Exchange Commission, SEC, does have very, very strict rules on it. But there are many syndicators out there who have the expertise and access to a lot of deals. My syndication partner, for example, is so well connected and been in it so many years. Last year, he got over 300 deals sent to him, including a lot of off-market deals, every day.
Wow.
Per day.
Wow.
That is not typical. And that's the kind of person you want on your team, or that's the kind of syndicator you want to find, is someone who can, who have access to a lot of deals, have, of course, successful track record, have high integrity, that they know how to negotiate the best deals. They take all of these thousands of deals and find the nuggets in them. And that process is very time-consuming, takes a lot of experience, takes a lot of staff to find ones that are worth checking out more closely on the desk, then going out to see it, then doing the due diligence, putting out a letter of intent, negotiating a price that will work for their investors, and so forth. So, of course, that's transparent, or the average investor doesn't see all of that work that goes on to find these nuggets. But a good syndicator then will offer a product. We have one now called Western Crossing. It's a $20 million retail center. And for $50,000 a share, a person can invest in a Class A center that has 98% occupancy in a region that only dropped 2% in occupancy during the last crash, and housing market only dropped 1.2%. It's unheard of. People don't even
that's a level of stability we certainly never saw in California.
So so $50,000, and their liability is they have no liability other than the amount that they originally invested, and it's you can buy as many shares as you want, and that's typical. So I've done about 10 syndications. I've offered about 6 of these to other investors. So here's a way for someone to take advantage of a syndicator's ability to find properties, negotiate them, and a good syndicator will also have property management company that can manage that product, because you want to make sure that you have the maximum chance of the results being obtained. And if you have that control over it, and the syndicator has incentive, because most of their, a good syndicator won't take a lot of money up front. They'll take most of their reward at the end. So they have a high incentive to make sure that property performs.
So at the end of the day, talking about maximizing your ability to leverage, minimal exposure, very broad spread risk in that arena. And I have to wonder now, do these investors need to be accredited?
Depends on the type of investment.
Okay.
So SEC has 2 different kinds of investment. And one's called a 506B. It's part of Reg D, which basically doesn't impose the same rules on you that, say, an initial public offering is for a company that's going to go public, if you will. It's restricted to private individuals. So many of them can accept both non-accredited and accredited. The current one we have is a $5.8 million raise. So we felt that we'd want to have access to general solicitation, and in that case, it is just accredited. But if someone's interested in this kind of product, where you're taking advantage of someone else's skills and ability, if they connect up with us at TomWilsonProperties.com, get on our list. Then once on our list, you're part of our database, you're part of our client base. Then you get to get offerings that are for non-accredited as well, as they come out with time.
There is a special opportunity right now that after a timeout I'd like to have you spend some time educating us on. You made reference earlier to Western Crossing Retail Center and these amazing performance numbers just in terms of the level of occupancy, and how well this part of the country has been able to fare through the recession of 2008. In fact, in many respects, doing even better than markets like San Francisco or Los Angeles. So let's take a time out. We'll come back to more of the conversation. Tom Wilson with Wilson Investment Properties with us today in studio. By the way, more information available on the web at tomwilsonproperties.com. That's tomwilsonproperties.com. A brief time out, back with more right after this. Welcome back to the conversation. On this edition, we have a very special guest in studio. He is Tom Wilson with Wilson Investment Properties. We've been talking about the arena of real estate investing, some of the advantages and disadvantages, some of the opportunities that are available for, let's say, the average investor out there who doesn't want to get caught up in the minutia of a single-family dwelling and the responsibility of having to manage that property on their own. And, of course, as we learned from Tom Wilson, some of the rules of engagement have changed in recent years. So looking at multifamily dwellings, particularly of, say, 5 units or above, are becoming further and further out of reach to the average investor there. So if you want to get a nice ROI, you want to be able to have a greater degree of shared risk, what are some of the other opportunities for investing available to you? Syndication, as Tom is educating us today, is one of them. And in particular, Tom, you're talking about access to properties that the average individual would not have a chance to reach, even if they had large net worth.
Never even dreamed of being able to have access to.
And toward that degree, you shared briefly prior to the break some markets in the country that have just been on fire, and in fact have a demonstrated track record that they fared through the 2008 downturn even better than some of the really big, popular, quote-unquote, hot markets like San Francisco. And one of them is located in Texas. Tell us more about not only what's been going on economically in the state, but in particular with this one property that we mentioned in Amarillo, Texas, called Western Crossing Retail Center. What's been going on?
Well, first of all, when I decided at the end of a 30-year high-tech career that I was going to go into full-time real estate investing, because I, after 30 years and taking some what many consider to be a big risk back there in the 70s to invest in houses, I had a lot of folks that said that had then gray hair like I do now that said, Tom, prices have gone up so much in the 50s and 60s. I don't think they can go up anymore. I think it's pretty risky to go buy, So I took that big risk and bought that first $30,000 house.
Little did we know.
No. So yeah, they do keep going up, but not at a continuous straight line. They have to take some corrections every now and then when they bubble up a little bit. But so when I decided to go full time, I was shocked to find that the returns were a whole lot better in other places at that point in time than they were locally. So I spent about a year and a half studying the country, and as I said before, I really leverage off others who are smarter than I am, have more experience. So I interviewed everybody I could find who was a successful real estate investor and asked them what they'd learned, where they were investing, put together the list of cities, went and investigated all those myself, got my own data, went to a lot of them, and Texas came out on top. And to this day, I would say it's even stronger in relation to other states than it was at the time I chose it. So I lost no products in my during the downturn. I was mostly in Dallas-Fort Worth. It dropped 7.7%, the lowest of all the major economies in the country. So my cash flow kept coming in. Had a little bit of a setback, but nothing that affected any of my cash flow, and they're now back higher than what it was before. So what do I like about Texas? It's a pro-business state. If you look at the chart of the last 10 years of all the companies that have moved from other states to Texas, it is staggering. And, of course, the longest list is from California. Most recently, Toyota said it's picking up its roots from Seal Beach, and they're moving out to Plano and Texas. So why is that? Well, they're very pro-business. They're centrally located in the country, in the Americas, not just United States, but all of the Americas. So even though we have the convenience of internet these days, and easy to communicate, people still like to get a response in the same day. And so being centrally located in time zones is good. For distribution, it's very good. Texas has added more jobs since the crash than all the other states put together. That's hard to believe,
Wow.
but that's staggering. So companies are just flocking there because it's easy to set up business. Doesn't mean there's no regulation. There's a lot more than there was 10, 20 years ago. But it's a lot easier, and they do things to incentivize and help businesses. Their employees have affordable housing costs. So, that's a plus. It's the lowest cost of living of any major economy state. It has the most stable, financially stable government of any of the major economy states. So Texas is just an amazing place. We like Dallas-Fort Worth especially, but we found a product through this process of sifting through thousands of things that come across our syndication group's desk. And this one came up, this retail center in Amarillo, Texas. Well, I knew Amarillo was up in the panhandle of Texas, but I didn't know a whole lot about it. And of course, we're not going to invest in something unless we're good enough to invest in it ourselves and recommend it to our family, which indeed we have. So Amarillo is the economic center of that whole region of the Texas, Oklahoma panhandles and eastern New Mexico. It owns economically that 250-mile diameter space between Denver and Dallas and Albuquerque and Oklahoma City. It's a 3,600-foot high plain, and it is the oasis for that whole region. 40% of all of the purchases come from people outside the area. The anchor stores there, their next closest anchors are over 115 miles away. As I said, it only dropped 1.2% in housing compared to, say, 7.7 in Dallas, which was the lowest major metro in the United States. Amarillo is 250,000 people, and they've got big economic redevelopment going on downtown. We met with the Economic Development Center. We met with the Planning Department. They have a very vibrant medical center area. Very progressive town. Population has grown every single year since 1991. So we're 97.1% retail occupancy. Lowest it ever went in the crash was 95%. And this, so that's some points about Amarillo. And for a small city, 250,000, it's amazingly broad-based economy. I've never liked one-horse towns. Going into North Dakota was, an okay gamble if you knew that's what you were doing. But I always like places that have a broader-based economy. Even a place like Memphis bothers me some because if FedEx closed its doors, it would have a major impact on that city. So I like broad base. So what does Amarillo have? They have Bell Helicopter built a major facility there 10 years ago. They have some energy production, but not oil. They have a lot of food processing. They have metals processing. They process one quarter of all the beef in the United States there in the Amarillo area.
Wow.
So it started in the mid-1800s as a rail stop. There's 4 major U.S. highways that go through there. It's a oasis crossroads, and it was a place to exchange commodities, and as it is today. Very fascinating place.
This particular piece of property, Western Crossing Retail Center, as you mentioned, amazing number of occupancy, almost 98% occupied, which to any investor, that's always golden. And the way this particular syndication is being set up, investors can take advantage of the triple net. Talk to us about that.
Yeah, so commercial properties have the advantage over multifam, in addition today of having a higher return by about 2 percentage points, no matter which metro you're in, or at least I say 2 percentage points certainly in a place like Texas. Same percentage difference in other places. So it has 4 major anchors, and we don't. It's only 8 years old, fairly new, and yes, 98% occupancy. And we don't take on any retail center. We're very sensitive to the internet competition these days. It's made headlines a lot. Some of our prior retail centers have been mostly neighborhood services. Indeed, the strip section, which is part of this property, has neighborhood services. But the 4 anchors are ones that we've checked out very carefully. We've looked at their financial situation. We've looked at the Wall Street analyst projections on them. They are not the kinds of products that tend to be quite as internet competitive. So we have Berlin Coat Factory, which is not just coats these days. It's a major clothing store. Most people still like to try on something before they buy it. Has Petco in there, the leading pet supply, and people still like to go interface with people and get sort of a service about what's best for their pet. So they may buy some products online, but most people prefer to go in there. Michael's, which is a major art and craft place. Creative people like to go touch and feel and see things. They may order some things online, but it's the kind of place people like to go. And Mardell, which is not national, but is the largest Christian supply store in the Bible Belt. And I wondered before I went in, what would I see other than books that could be bought on Amazon? Well, I found that books is kind of a small part of it. A third of the store is homeschooling, and they have meetings there about how to homeschool better, and they have, they have many other kinds of supplies and gifts and things that people like to be able to see and pick out. So the analysts indicate that these 4 anchors they feel are going to do very well moving forward. This is a 7-year planned exit. By the way, as an aside, I'm amazed at how many of our investors have told us that they've invested in syndications before that had no exit plan. I couldn't believe that. Every syndication we have has a defined exit. We may vary it if it's in the best interest of the investors, but this has 7 years, and that's partly driven because the assumable loan that we're getting at a fixed rate for the entire time is retiring the following year, so that's a good time to exit. But anyway, we feel this is an exceptional quality product. It's on Interstate 40 with 84,000 cars that go by there a day. It's the highest visibility of any retail center. It's 2 miles down the road from the only mall, which is Westgate. And the leasing agent tells us that there's higher demand for anchors to move into Western Crossing than they are in the mall because of the visibility, the 4 national food brands that are in front of it that help draw in crowds, and the 3 national hotel chains that surround it. So it is amazing property. We spent several days there vetting it ourselves. My partner has managed a Best Buy there in town for a few years. It's a very, very amazing product. I would say that this is the highest value product we've been able to offer to our investors yet. It's a higher return than you'd normally get. We're talking 8% preferred return, 14% internal rate of return, annual return on a Class A center. That center here in San Francisco would be a 3 or 4% return. So that's what you can do by going to another area, getting a syndicator that knows how to find these nuggets, and it's just a product that we're very, very excited about.
For investors that would like to dig a bit deeper, you have a special meeting taking place this Thursday. Tell us about that.
Yeah, we have a meetup at the Biltmore on US 101, just off of it in Santa Clara, and it's at I believe it's at 6 o'clock. And indeed, to meet up where people can come and learn more about it and meet other like-minded people and exchange information. These meetup groups are just fantastic.
So a good place to come, get your questions answered, learn more about Western Crossing Retail Center. Of course, complete details available, too, at your website, TomWilsonProperties.com. TomWilsonProperties.com, and I believe there's a very informative video up there too, where folks can kind of get a tour of the property and learn more.
We're doing videos of all of our properties now. We We now all of them have drone shots, and it's and if you are interested in it, let us know. We'll send you what's called a private placement memorandum, either electronically or physically, whichever you prefer. And it is it's a document that the SEC actually doesn't require us to have for accredited investors, but we do it anyway. It's an expensive document to produce, but it gives very detailed information about all of aspects of the product, all of the information about the returns, the spreadsheet, that all the assumptions, what it's based on, and it includes all the regulations. SEC wants to warn people that make sure they understand that when you invest in anything like this, there are risks associated with it. So it's a very good document. It gives a lot of detailed answers, much more so than the typical private placement memorandum we've seen out there.
So to get more information, you can call Tom at area code 408-867-1867. That's 408-867-1867, or go online to TomWilsonProperties.com. That's TomWilsonProperties.com. Well, Tom, I appreciate you taking some time to educate us on the opportunities that are available for investors out in the world of real estate. Hope to get a chance to visit with you again soon.
Thank you. We're just very excited to be able to bring to investors, a product that in this marketplace where everybody's looking for higher yields, something that has this good a quality and this low a risk for a 14% annual return is just, it's so good I've recommended it to my daughter.
Fair enough. Details again available on the web at TomWilsonProperties.com.